said I couldn't do it and I did it. Look at my bank account, I'm running up the digits. I ain't in all that doing that facade shit. I walk it, I talk it, I live it. Come to the birdhouse, look at the garage, nigga. My Bentley coupe got a couple pigeons. I was down on my ass, had to go a new direction. Bought my mama Gucci purse, gave it 10 racks, told her you ain't gotta stress it. It ain't even an emergency and a nigga about to pull up in a 911 just to feed my dog. I told God it's a blessing. Came from the bottom, down below. Remember them cold nights, I was sleeping on the floor. Always dreamed about the 4G, I don't feed, now they down below. A nigga got so much money on me, I can't count no more. Down below, 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 Roddy Rich said I never took the safe route. Nigga came from the bottom, I had to make it out. I was trapping in the box, I had to break out. Hurt my soul when the feds kicked down the vacant house. Black truck on the corner, they had a stake out. Seen a dope boy pulling out a rafe out. Had to get about the hood to the lake house. The head chef about to bring my steak out. I was born to
Alright. Right, so welcome to our midweek market review. I don't know if you guys are hyped for this call. Type A1 on the chat box. Let's go. Type A1 in the chat box if you guys are hyped for the call. Let's go. Yeah. $64 people on this call. 64 people. Let's go. Alright, perfect. Damn. These guys are wild in the chat right now. Okay, alright. So, welcome to Gene's 3 hour, kind of like a 3 hour session. So, I'm not really sure if we could do 3 hours because I think there's opportunity calls by 8 p.m. But, so what I actually decided to do was rather than trying to, teach something new, rather than, going over, because basically what we do every week is like we go over the same thing each week. And I felt rather than just doing that, let's switch things up a bit. And so what I actually decided to do was to ask you guys questions, to send me what you wanted me to teach on. And so far, only guys on my team sent me what they wanted me to teach on Telegram. So I was expecting I would see messages on Instagram or Telegram or something, and it was only from the guys on my team. So all the questions from the guys who said they wanted me to teach something, this was the majority of topics people said I should cover. So I think that's what we're going to do today. We're going to try to cover all these topics. And the reason why I'm basically doing this is I know lots of you guys would have questions. Some of you guys have been exposed to institutional concepts, and that's there's something. There's a reason why you're not really that successful with the concepts yet. So I'm trying to help you guys put everything together. Okay. Can I explain my Euro setup today? Just clinches. What the fuck? Okay. So texting me. All right. So what we got on our screen now is utilizing stop losses when trading. Number one. That is what I'm going to cover. Top-down analysis. 2, 3 higher time frame analysis breakdown. 4 fair valuation. 5 weak candle formation. 6 magnet source. Magnet source is a special area. So okay, magnet source. 7 bread and butter setups daily. All right, so let me do it this way. Since I'm recording. So since you guys were unable to text me, oh come on, comments as well. Since you guys were unable to text me what you wanted me to teach on, we've got 7 topics right now. So I need 3 more from you guys. Can you guys just type on the chat box? I need 3 more from you guys. And then once I get those 3, we're going to start this call. COT. Oh damn, COT is very, very. What's the password for the room? There's no password. It's free. Determining your weekly bias. Okay, let's see. Mitigation block COT. COT is more complex. So Paladin for COT, I would tell you to reference new course coming out during the weekend. So I did a full section of fundamental analysis. Everything from COT, treasury bonds, intermarket analysis, the relative strength, signal tendencies, everything you would ever need to know about fundamentals trading. I did that. Now the reason why I did that way is because very rarely do we touch on fundamental analysis because it is very complex to try to teach fundamental analysis using institutional concepts. What I did was I started to devote one full section of the course to teaching the fundamental side of things. That way, for those who want to gloss over the fundamental aspect of institutional concepts, you can easily skip that because it's a mindfuck, right? If you're going through that, it is a serious mindfuck. So that was what I did. So for your question, I would suggest you refer to that. And Jada says IOF. What is IOF, Jada? So text me privately on the Zoom what IOF is. Because it's determining your weekly bias. I think someone asked that already. Determining or higher time frame analysis breakdown. Yeah, basically. So determining weekly bias is on three, which is higher time frame analysis breakdown. Let's go. Signs of NY reversal. Okay. Weak formation is there already. PDRs. I did PDRs. Covered that link at length actually on the course. So if you're looking for PDRs, just be patient for like the next 3-4 days. You got everything complete. Premium discount market. That's PDRs. Weekly bias. Same thing. Liquidity voids. Okay. New York. So people are asking about New York and then CBDR Asian range. Okay. So day trading there, CBDR Asian range. Let's add that. So make this 8. CBDR. CBDR and and Asian range. CBDR Asian range. Perfect. What else? Let's see. We need 2 more topics. Confirmation checklist. I think that would be a part of top-down analysis. Okay. Oh, all right. So, what is COT? Please, I need to function checklist, new course looking lit, function checklist, NR reversal, stational order flow. Stational order flow is relatively easy. What's this? Anyways, basically. Oh, damn! Messages are going up. Let's get it. I'm looking for 2 more topics. 2 more topics. Mindset for swing trading outlook for them. Okay. Now that is a very interesting topic. Mindset for swing trading outlook for them. So 9 mindset for swing trading and how to manage also outlook for them. So let's add how to manage. Okay. And to anticipate them. Okay. So we have 9 and 1 more. Let's see, 1 more. Whew. SMT divergence intraday. Should I do that? SMT. Really boy, talk about your philosophy. My philosophy. Okay, so let me tell you guys something real quick. In the institutional course, right? So in the institutional course, the first part of the first section, right, of the institutional course is the introduction to ICT concept. That is my December bootcamp. Because what I did on the December bootcamp was like basically introduce you guys to all the SMT concepts. That's why if you guys have not gone through that, you need to visit that. Okay, so now after the introduction to ICT concept, which is basically my December bootcamp, and just me adding some extras, right? Then once you go into the real advanced stuff, I started real advanced stuff with like a 2 hour session, not really going over trading out, going over, I call it the red pill. So that section is called the red pill. And in the red pill, I break down the the rules of money being changed in 1971, Richard Nixon, how the Federal Reserve was created, the US taxation system, everything you need to know about the monetary or the financial aspect of the entire world. So I cover everything on the red pill. So that way, because I know so many guys are really not informed about uh, how the entire world works, basically, as regards to money and how money moves in and out of hands in the marketplace. So what I decided to do was I decided to create a small little section for those who are actually open-minded and want to listen to me talk. So what I'm going to try to do is I'll use data. So I did kind of like a small research, right? So I know most of these things actually, but I just went back and did more research and package some things together, drop it on the red pill. So that red pill, to me, that is the most exciting part of everything because you begin to see into the way the people actually control the entire world government and also control the financial monetary system. You get insight to the way they view things and also how you can structure investments, how you can handle your money, how you can just so that you can increase your sources of income and all that. So or I feel that the red pill section is very it's one of the most interesting sections to me. So how's your algorithm? Okay, IPD, I love IPDs. So we have 10. Let's go. Ah, finally 10 IPD. Oh no. I think I made a mistake. Okay, 10 IPD. Let's see. In bracket, why does this exist? Big question mark. Okay, so now we're complete. We've got the. Let me actually delete this. Whew. So first question, we've got utilizing stop losses when trading. Two, top-down analysis. Three, higher time frame analysis breakdown. Four, fair valuation. Five, weak candle formation. Six, magnet source, which is also IPDA. Seven, bread and butter setups. Eight, CBDR slash Asian range. Nine, mindset for swing trading and how to manage. And 10, IPDA in bracket. Why does this exist? Okay, so made a mistake the last part. So I think we're ready to roll. Here we're ready to roll. So utilizing stop losses when trading. Let's go to the chart example. So now today, you know what I often do is I teach theories. But I like to teach theories first before we do a live chart example. So what I'm going to do today is straight up live chart examples. Everything you all need to know as regards trading. And drawings. Let's see. It's TXY. Why is this slow? Ah, come on. Tell me you lost all data. Oh, let me go drawing. So, what can we use to? Someone suggests a pair for me. So let's use that to answer the question. Using stop losses when trading. So someone suggests a pair for me, so we can use that for teaching. Let's see. GU. Okay. GBP USD. All right. So GBP USD. Let's see comments. People click recording. Yeah, I'm recording. Ready. So pound USD. So let's delete data on the GBP USD. Let's see how would we use stop losses. All right. So now let's take today. Right. Let's say today. So today buys. This is where I was looking for a buy entry, but I was thinking Euro pound was going to rally. That was why I preferred to trade Euro USD over pound USD. But then pound made a very phenomenal move today, right? And then now let's assume you found this level, you want to take a trade off that level, right? Let's say you're day trading today on GBP USD, you wanted to take a trade off this level. How would you utilize your stop loss? So now the first question you gotta ask yourself is, what do you think is the last support where if price gets to, you don't think price would keep going up? What was the last point on your chart you feel if price gets to that point, price would make a reversal and just keep selling? That's the first question you ask yourself. So the first thing you need to do is to establish your bias, right? So my bias today was bullish. So let's say if I was bullish or you were bullish, right? And then you established this pink zone was where you wanted to buy. Okay, you wanted to buy at that pink zone. Now the next question you ask yourself is, where's the last point that if GBP USD keeps dropping, I think it will just keep selling. Okay, or you either you do that for day trading or you do this. Okay, so there's two ways. So first off, if you find a discount array, come on, chance as well. Then let's see. Oh, damn, can't see. Okay. Okay, so people can't see. Let's see if we can fix this. I think it should get better. Never fluctuates. Why does it keep happening to me? I don't know why. Like seriously, seriously, every single time. Hmm. I don't think I can fix this. I'm actually connected to my phone's data, so um, yeah, I'm connected to my phone's data, and that's what we're using for this call. So I think within the next couple of minutes, it should get better. So oftentimes, I just don't know how to fix this every single time. Once you start a webinar, screen gets very blurry. Then as time proceeds, everything starts to get clearer. So I don't know. Africa Wi-Fi is different. Not seeing anything. Okay, so no worries, brother. Continue the source. It's good now. Better. So people that Nigerian Wi-Fi. Okay, it's good. All right, cool. Let's see. Questions. Let's see. Questions. Still doesn't show your recording though. Yeah, so I'm actually using OBS Studio app to record. Okay, not Zoom. OBS Studio app to record. So sure, for sure, you're gonna get a recording for sure. Okay. All right. So now let's get back to the real topic of today. Uh, let's see. So now, there's two ways you want to play stop losses. So the first way is you gotta ask yourself this question: where's the last place that the market you feel if it breaks that level, it will keep going bearish, right? So that is what you gotta ask yourself first. So what I did was when I was trying to just marking up GBP USD this morning, so I went to the 4 hour time frame. Obviously, I was bullish because the situational order flow is bullish, right? So what I did was this 4 hour bearish order block was what I was looking for, for price to key off that level and rally higher. Now, the open to the close of that order block was where I drew my initial range. That was where I wanted to buy, but then I decided to take your USD rather than GBP USD. But now, if you look at this green line, right? So the midpoint of this down candle is what we call the mean threshold. Okay, so I felt that if the market dropped down into that level and broke through that level, that we probably would reach for these lows. So that was why I drew up that line there. And now, if you switch to the 15-minute time frame, which is today, all right? So now, assuming I wanted to buy from this level, so let's say I was taking trades from that level, and this green line to me is where if price breaks through that green line, that is where I would not want to buy, right? So what I'll simply do is I'll place my trade around that level, and then my stop loss to go about 5 to 10 pips below that last point. Should price come there to weak that level and quickly rally up? Okay, so you give a leg room of about 5 to 10 pips, okay, of that level. So that's one of the first things you can do, right? So the first thing you can do is find a level whereby you feel intraday, if price gets to that level, price will just keep dropping if you're bullish, right? And then you want to place your stop loss about 5 to 10 pips below that level. Now, there's another thing you can do whereby you're using the average daily range. Okay, so oftentimes, majority of the time, what I like to use is average daily range. So average daily range in the sense that if you look at British Rand years, right? So the average daily range in the last 4 or 5 days could be like 130 pips, right? So 130 pips, if you divide that by three, okay, so make sure you take note. Let's say the ADR of British Rand USD is 130 pips. If you divide 130 pips by three, you get I think that's about 33.33 pips, basically. Okay, so now if you look at the market, let's say the market wants to go bullish. Oftentimes on bullish days, one third of that daily range would be the Judah swing down. Okay, so the Judah swing, once the market opens and the false move down, that is oftentimes going to be one third of the ADR. If the daily range is going to go bullish. Okay, so price should not really, the Judah swing should not really exceed more than one third of the ADR for that day. Right. So what I simply did on Euro USD today was now I'm sure some of you guys saw my setup on Instagram. On Euro, so now this is what I was looking at on Euro USD. Right. So price came to this level, 15 minute order block, and so what I basically did was, if I was looking for a bullish day, it dropped down. Price has moved about 60 pips. So I could have even like narrowed this all the way up to 10 pips or something, right? Because I knew once price took out this level, it was reaching for this level. And now, coupled with the fact that Euro USD has oftentimes Judah swing on Euro USD would not be more than 30 pips. So if you're seeing a day whereby the Judah swing is about 50 to 60 pips, that is telling you price is reaching for a very deep discount, and then the next day could be a very explosive move. So you could hold positions, right? And then when you're taking that trade, you could use 10 or with our rules, right? If price breaks through this last point, we know price is reaching for this point. So we could do 5 pips below this last bearish candle. So we go 5 pips, just like the way I did, right? So 5 pips with this last bearish candle. And that gives us our stop loss for about 17 pips for our TP1 of about, I think it was 80 something. So those are the two ways you want to use stop losses every single day. So either you're using that via PDRs or using that via ADR. So those two ways, ADR or PDRs, select one. So depending on what the market is presenting to you at that point, or you could even combine the both of them together. So you could use PDRA plus ADR to find stop losses. But all for my rules is, if price goes above 35 pips, if I'm not trading oil or gold, where I don't take that trade. So sorry, oil, gold, or GPAD, right? So if my stop loss is above 35 pips and I'm not trading oil, gold, or GPAD, I don't take that trade because I don't feel it's worth it. So what you gotta do is you gotta find what works for you and then set up rules regarding what works for you. So this is why you need to go back to your charts and study what you're learning. You're not just learning every single time. You need to actually study and see it for yourself on your charts that this is what price is doing. So that way your eyes get trained to what you're learning. Okay, so Judah swing is the false move of the daily range. Now let's say the daily range is bearish. Judah swing is that up move from 0 GMT or 12 midnight New York time. The false move higher on a bearish day is your Judah swing, all the way up until London kills when that's your Judah swing. And then the false move lower on a bullish day from 0 GMT or from 12 a.m. EST, 12 midnight New York time. Right, the false move down is your Judah swing. Now, so for example, if you look at Euro USD, I was looking at this as the Judah swing, right? This false move down, price went down. That was what I was considering as the Judah swing. And so basically that is that. All right, so let me get a bottle of water and then we go into question two. As usual, this is a 3 hour session, so we're not leaving here until all questions are answered, which is at 10. Okay, so we've created a list of 10 from everyone who asked questions, what they wanted me to cover the most, and this is what I'm going to do one by one. So we're done with this. Let me put X there. So go to the next question, which is top down analysis. Okay. All right, so let's go to the next part, which is top down analysis. Okay, so you're seeing you guys going well in the comments. Let's see. Is this recorded? Yes, this is recorded. The potential trade is more than 35 pips. So pairs, I don't consider trade. Yes, that was what I said. Can I get a recap of how Judah swing works? No, we have to follow the schedule, which is this. Until I'm done with this, then we don't really have to deviate and keep answering questions. So, top down analysis when trading. So, how many guys are satisfied with the reply so far from the first question, which is utilizing stop losses when trading? If you're satisfied with the answer, type a one in the chat box so I can know if we're gonna move to the next question or not. So let's see. Okay, so one, yeah. Question two, top down analysis. Right, so top down analysis. Let me do a breakdown of Euro USD, my top down analysis. So now, you can get your notes so you write the theory behind top down analysis, right? The big question is what is top down analysis? Right, so top down analysis is simply sifting through all the time frames to see if the market basically is agreeing with itself. Okay, that is top down analysis. Top down analysis is simply you going from the highest time frame all the way to the short term time frame, which is the 4 hour, 1 hour, 15 minute, or 5 minute, even the 5 minute time frame, right? So, you're all the way from that monthly time frame all the way to a 5 minute time frame, trying to come to a general conclusion of what the market is going to do. Why is the chat sprawling? Oh, screen is what is going on? What is going on? Come on. Okay. All right. So some people say screen is good. Others say screen is blurry. So I don't know. Who am I going to listen to? People say screen is blurry. Others say screen is good. I need to. All right. Okay. So let's go to the monthly. Right. So when you're doing top down analysis, right, you want to start with the monthly. So you want to go from like the monthly all the way to a 5 minute time frame, right? So wow, we're full. So what you want to do in doing it top now, the reason why basically the reason why you got to do a top down analysis, or the reason why this is very, very, very important to you as a trader to incorporate top-down analysis into your trading because that gives you a broader perspective of the marketplace, also a short-term perspective of the marketplace. So that way you can trade with the market flow. Because if you're not looking at the monthly time frame, the higher time frame basically, or if you're not looking at the smaller time frames, you can't really get an insight into what you expect or what you think the market is going to do, right? So now let me give you an example. Let's say I'm standing on the field, right? So Ginny's standing on the field, and then there's a rabbit running across the field, right? And then there's an eagle in the sky looking down on that field, looking at the rabbit running across the field. So, who do you think is going to get a clearer perspective of where the rabbit is running to? Is it me standing on the field, or is it the eagle in the sky looking down on the field? What do you guys think? Me or the eagle? Let's see. Who's going to have the better view, myself or the eagle? Eagle, exactly. So this is comparable to you looking at the higher time frames and also you just looking at the 4 hour, 1 hour, 15 because if you're looking at the higher time frames, it gives you an insight into where the institutional order flow is. It gives you an insight into where the banking levels are. Remember, the banks use the monthly, the weekly, and the daily time frames. This is where they execute their trades. The short-term time frame basically is for retail trades and some of the smaller hedge funds, right, where the central banks basically offset prices with their pending orders. But majorly, where majority of the bulk of liquidity would rest is especially on these higher time frames. Okay, so bulk of liquidity is going to rest around the higher time frame. This is why when you're analyzing, you always want to go from the monthly to the weekly, to the daily, the 4 hour, to the 1 hour, then you can day trade your positions from the 15-minute time frame. So let me give you guys a very, very quick example of USD monthly, right? So let's remove all drawing tools. Now, the first thing you always want to do is you want to identify where you are as regards to price. Are you at the discount level or are you at the premium level? Okay, so now let me take a cue from my PDRA video recording. Let me ask you guys a question, right? So, do you really think support and resistance exist in the marketplace? Let me see a yes or a no in the chat box. Do you really think there's such thing as support and resistance in the marketplace? And give me your reasons why. Don't just say yes or don't just say no. I don't think so. Give me reasons why, so I know this is a legitimate reason why you're thinking there's no real support or resistance in the marketplace. Let's see. Yes, because price suggests okay. No, because price is predetermined. Okay. If you're saying yes, give me a reason. If you're saying no, give me a reason. Okay, yes, because the banks free them. Yes, other blocks are true support resistance. Fair value is my support resistance. No, everyone has different eyes view of the market. Yes, because I think it's a zone. Okay, yes, because they would have to follow flow of market. No, there is only true support resistance. Okay, premium and discount. Supply and demand and our other block. So is there anything such as support resistance? Is there anything such as supply and demand in the marketplace? Give me reasons why. I'm trying to make this kind of like an interactive session so you guys can get real value or knowledge from this call. Okay. Yes, cause price bounce off it sometimes. Okay. All right. So there's support, there's resistance in the marketplace. All right. Cool. No. All right. So let me ask you guys this question. Do you now let's say for example DXY. So now, do you think that the U.S. Federal Reserve is going to TradingView and doing this? Right. Let me ask you guys this question. Do you think U.S. Federal Reserve is going to TradingView and doing this? Oh, there's support around this line. Let's buy the market because there's a line around this point. Okay, the market should go up. Do you really think that U.S. Federal Reserve is doing that? You're going to TradingView. You're looking at the line. Okay, saying okay, yes, this is the line. This is an horizontal line. Let's buy the market up. Exactly. Exactly. So now let me ask this question once more. Do you really think support and resistance exist in the marketplace? I'm asking this question once more. No, there are no support resistance. Do you think they use trend lines? Do you think the US Federal Reserve goes to the market and uses trend lines and then checks for RSI? What? This is funny. Exactly. RFP trend lines. Yeah, so they go into the marketplace. All right, so the MACD needs to cross here, and RSI is currently at 7, and the trend line is saying downtrend. Okay, so now price will broke out of the trend line. Let's buy. No, right? Because IPD is engineering price for them, right? And then they are the ones capitalizing on the move. So now let me tell you what really exists in the marketplace. So make sure you're taking notes. Support and resistance does not exist in the marketplace. Okay. Supply and demand does not exist in the marketplace. That is all false. The true thing that exists is expensiveness and cheapness. Okay, let me type it out. So people are going to be like, what? Let me type this out real quick and I'm going to explain, okay? Expensiveness and cheapness. Oh, we went. Expensiveness and cheapness, that is what exists in the marketplace. This. Okay? So let me do it this way, okay? Expensiveness, aka premium. Cheapness, aka discount. The real things that exist in the marketplace is expensiveness and cheapness. Support and resistance is false. Supply and demand is false. What exists based off what the central banks are looking at is expensiveness and cheapness. Jerry's categorized as cheapness. there's no okay, alright, so now natural support resistance are simply zones where IPD will look to execute price. Your zones. What actually matters in the marketplace is expensiveness and cheapness. So now to really, really break this down to you guys, right? So now let's break this down to you guys. Let's say an iPhone comes out, iPhone 12 or something. Okay, let's say an iPhone 12 comes out. And this week, right, they're launching the iPhone 12. When it comes out this week, iPhone 12 is going to retail at $1,000 for one iPhone. Right, so iPhone 12 is going to retail at $1,000 for an iPhone. And then iPhone then says by next week, the price of the iPhone 12 is going to retail at $3,000. So now let me ask you this question. Would you buy extra just to save up that iPhone for next week? You know, buying up one iPhone for $3,000 and waiting until the next week so you can sell that same iPhone you bought $1,000 this week for $3,000. Would you want to buy the iPhone this week so you can save it and then sell it when it's at $3,000? Let me ask you guys that question. Or do you think it's a very poor deal? Would you? Exactly. Why? Because you know, whilst you're buying the price, it is cheap relative to the next week where it is going to get expensive. The same kind of logic you're using to trade, okay, which is you want to buy things while it's cheap. Exactly. Exactly. It sounds like the most basic principle of barter trade. You buy low, you sell high. Right? You want to buy something while it's cheap, you want to sell it while it is expensive, relative to the point where you bought it at. Okay, so this is exactly the way the central banks view the market. They buy price when price is cheap. They sell price when price is expensive. The same way you want to buy your iPhone while it's at $1,000 and sell it while it's at $3,000, it's exactly the same way the central banks move price on your charts. So what you're actually looking at is discount and premium. So the first thing you want to do is you want to pull up a range. Okay. So you simply pulling up that range gives you a point of reference because you need a point of reference to understand discount, which is expensive, cheapness, and premium, which is expensiveness. So the first thing you want to do is you want to get your reference point. Where is this? Where is the top of the range and the bottom of the range? So now if we use your USD monthly, so where is the top of our range, right? range high here, range low here. Okay, so that is the top of our range. This is the bottom of our range. Okay, so I'm gonna put price to this one. Okay, so does it make sense so far, or do you guys still have questions? Does it make sense? Let's see. All right, cool. So now, once you've identified your range, pull up your Fibonacci, right? You want to get the midpoint of the range. You want to get the range's midpoint, right? Which is this. The midpoint of that range becomes your equilibrium, your 50%. That is your midpoint of the range. Anything below this line is discount. Anything above this line is premium. So you know if price starts to reach for this midpoint, price is looking for a discount level. So now the next thing we ask ourselves is, on a monthly basis, where is our institutional reference point on a discount basis? This last down candle. Okay, so this last down candle is a bullish monthly order block. So now some of you guys might ask this question, Gene, why didn't you use this last three candles like you thought in the last webinar? Because now, if you use this 1, 2, 3 down candles, after this 1, 2, 3 down candles, there's a bullish candle. So that nullifies all those 3 down candles. There's a bullish candle followed by a bearish candle. So this bullish candle nullifies all those 3 down candles. Remember, your bullish order block is that last bearish candle before the extrapolated move higher. Okay, so now this last down candle. Now what we want to do is we want to identify the midpoint to the open of that candle and then draw it out so we can find our zones. So do something like this. This is the 50% of this range. Put it all the way up to this point. Okay, so we are going to do it like this. Get this rectangle going. So this is our discount price point that we're looking for on our range. So this right here to the central banks is very, very discount level. This is a very, very cheap level for them to buy up Euro USD. Okay, to the central banks, what the US Federal Reserve will be looking at is this is a very cheap level. Okay, now I'm not saying necessarily that once price gets to this point, price will keep going up. Okay, you need to take in all the various market conditions. What I'm saying is generally, or this is the general rule of thumb, once price gets to the discount level, you want to see some buying off that level, just like this week, right? So once price tapped this level, boom, price went back to the midpoint of this range. Now price is currently around that level. So you can expect central banks buying off that level, not necessarily having to get back to the top of this range, right? But you want to see some level of buying off that point because they will consider that price cheap. Okay, so now you've identified your monthly discount level. Now you break it down to the weekly. Now, one more thing. Off the monthly, where's the last swing guide? There's a swing low, swing guide, swing low. So this is the last swing guide that comes in form of a rejection block. So this is me simply doing a top-down analysis. This is what I would do, right, if I'm trying to trade. This was exactly what I did this morning while I was trying to take a setup on USD. Okay, so from the monthly, you go to the weekly. Let's see what the weekly says. Right, so this is our monthly rejection block, right? And then now, if you look at price on the weekly basis, you can see price came to the left side, valued up, went through, then shut up once more from the discount level, and now price retraced back into where this last rally the marketplace came in. Okay, so how many of you guys actually went through my lesson cutting through candles? Right, so how to cut through candles to find support resistance in the marketplace. How many of you guys have gone through that video where I taught cutting through candles? Yeses or no's? Let me see. everyone says no. Uh, okay, so I think I'm going to have to teach this once more. Right, so I'm going to have to cover that more in detail. So just basically, when you get to the course, it's going to be in the introduction to ICT concept. I talk basically on cutting through candles, whereby you cut across a candle to find support, or you cut across a candle to find resistance. Okay, so when you cut through candles, the last buying, institutional buying, came in the form of this region on a weekly basis, right? So if you move that across through these candles to this point, that is exactly what the market is doing. So let me just make this easier. Okay, so this level of support, that is a level of support in the marketplace, because previously in the past, for some reason, institutions thought it was ideal to buy around that price level. So should price break down and go up, I want to come back towards that level, we could expect some form of buying of that level. So basically, this is our weekly analysis. What you also want to do is you want to identify the weekly swing high as your potential weekly target, okay, which is this swing high. Okay, so this. All right, so that is our. This is a monthly premium level, weekly premium level, where we can reach for from this discounted price point. Now we go to daily time frame. All right, so now from daily time frame, you saw price tap this level perfectly. Price, traded all the way back up. Now on the retracement, the market went to the mean threshold of this uh, bullish order block. Okay, daily bullish order block. Remember the candlesticks the banks are using, not the central banks. I'm talking about the banks, hedge funds you're using is the daily. So they use the daily candlesticks to execute trades. So the daily candlestick is very important in insight as to what the market wants to do. Now look at the nice little reaction of the zone of this main threshold, coupled with cutting through candles of this down candle, right? This bullish order block. That nice bullish reaction of that level tells us that there is some form of buying inside this range. Recapitalization of this down candle. Okay, this down candle price came back down to recapitalize off that move. So we could potentially see the market trade higher. Now, the next thing is my entry zone. So what was my entry zone? Why did I utilize that level as entry? So what I basically did was to find the eye of this down candle. That was my entry. So I entered off this bearish order block high on the daily. I just simply refined that level on the 15-minute time frame. That was it. Okay, so what I basically did was this. My analysis was something like this, right? So price came down to the level, tapped that level, went up, retraced back down, and then I'm looking for this of that point all the way into this zone where we have equal bodied candles rejection block. So from there you go down to the 4 hour, you're gonna see something more clear. So now as you begin to get down to smaller time frames, you're going to begin to narrow the zones, right? So you want to narrow the zones into where you feel the market can rally off of. Okay, so the 4 hour time frame is really nothing much to reference except that this is a bearish order block, 4 hour bearish order block. It's this. That is the level you want to look for as buys. Right. So some of you guys might ask me this question. Gene, why aren't you using this candle as a 4 hour bearish order block? Right. Why aren't you using this candle? Why are you not using this candle as a 4 hour bearish order block? Remember, all this price action is inside of these two down candles. Okay, so price was not breaking below this last candle. All this price action was inside of these two down candles. This is what we call inside bar setup, whereby price creates a down candle in anticipation for a bullish trend, and then the next couple candles just straight inside of the body of those or of that down candle, right? So we call this an inside bar, and that was the candlestick formation we used to take Euro pound trade last week. Also, DXY trade last week, where I said I was expecting a very explosive move in price. That was basically due to the inside bar candlestick formation, which is what makes me think that tomorrow, this is 1, 2, 3. Yeah, so tomorrow on Euro USD, we could see a very explosive daily range on a Euro USD price reaching for this level. I feel we can get to 1.0950 tomorrow. We can definitely get to that level. So I feel the market is making a very huge turning point around this point. Okay, and then inside bar candlestick formation, prices tested that down candle. You can see a very explosive move, and we could even potentially recapitalize all the way back up to 1.11349. Okay, so basically this was my setup. Then all you want to do is you want to go down to the 15-minute time frame, and then once you get to the 15-minute time frame, basically what you want to do is you want to begin to take into account the day of the week, the sessions, kill zones, what else? The 15-minute order block, fair value gaps, discount arrays, and all that. So you want to take into account all those factors to get yourself very sniper entries. So now look how we broke down the market from a monthly all the way down to a 15-minute time frame. Okay, so now what I basically did was this is Wednesday, Tuesday, Monday, right? So Monday made the low of the week. I felt this was the low of the week. Look at the way price basically total sub this low, right? So every pending sell stop around that level was taken out of the marketplace, and then the market rallied up. Now, as the market started to trade back down in finding the entry, what you want to do now is you know that this is a zone where you want to buy. Okay, there's a zone here where you want to buy on the 4-hour basis. Right, but now if you look at the 15-minute time frame, there's a fair value gap between this last bullish order block to this last swing low. So there's a fair value gap, and you want to see the market feel that. Now, something tricky. Let me point out this to you guys. Okay, so something tricky happened today, which was this very bearish candle. So now let me ask you guys this question: When some of you guys, how many of you guys actually looked at Euro USD for trade setup today? How many of you guys checked Euro USD on your chart for a trade setup today? Let me see on the chat box so I can make. All right, so lots of people are saying the same trade now. Okay, all right, cool. So now, how many of you, when you saw this very bearish candle, thought the market was going to keep dropping? Like when you saw this down candle, you either got stopped out, or you got scared and closed, or you thought the market was just going to keep dropping. How many of you guys, when you saw this, felt that? Today on Euro USD. Let me see the price. I stayed out. No, I don't think so. You got stopped out. Okay, I was reaching. Only 4 people stayed out and waited for it to break, but it didn't. But it's day. Nice. Okay. So France got stopped out. iPhone was sleeping, stayed out. So lots of people stayed out on. All right, so it was choppy. Okay, cool. Right. So now, you look at the way the market dropped. A lot of people thought the market was just gonna keep dropping, and it was gonna be a sell-off. Now, the reason why was oftentimes you're going to see this happen intraday, whereby the market prior to London session would trade a false swing low. So let me put X there. Okay, I'm gonna put an X around this point, right? The market would come and trade a false swing low. Now, let me explain the reason why the market does this. If price wants to move higher, remember fair valuation. If price wants to move higher, for that bullish move, there needs to be a counterpart selling. Okay? For you to buy something, someone needs to sell to you. Correct? You're going to buy an iPhone, someone needs to sell that iPhone to you. You're going to buy a car, someone needs to sell that car to you. You're going to buy a shoe, someone needs to sell that shoe to you. Correct? Let's see. All right, so exactly the same real world concept that for you to buy something, someone needs to sell to you. This is exactly the same with the central banks move price. For them to buy the market, they need to engineer sellers in the marketplace. Does this make sense? They need to engineer sellers in the form of sell stops. So now let me explain. Once the market came all the way back down, people are thinking, all right, so this is a swing low, right? Let's buy up the market. So now there's people buying up this market. People are buying up the market. Now remember, IPDA wants to move price higher. But now IPDA can't really move price higher if everyone is buying up the market because there's nobody doing this selling, right? For the market to go higher, there needs to be some selling for some measure of selling, right, for the market to go higher. Now, if everyone is buying up the market, there's no measure of selling for the central banks to key off that move and buy up the marketplace. So what they will then do is create a false swing low. You guys, let's say the neophytes now. So the neophyte retail traders buy up the marketplace. So they see the market going up, they feel good about themselves. They keep their stop losses below as they feel the market is just going to keep going up. And then what does the market do? Boom. Now, if the market is eating your stop loss and you're in a buying move, what does that mean? Remember, if the market eats your stop loss when you're in a buying move, that is the equivalent of you selling. If you're in a sell move and the market hits your stop loss, that's the equivalent of you buying. Does this make sense? Anyone, does this make sense? When price hits your stop loss in a buying move, once price hits your stop loss, you're selling that buying move in a loss. Correct? Yes. They say no for less for a while. I will. Okay. So let me explain it this way. If you're buying, right? If that buying move is closed, what basically, regardless if it's a profit or regardless if it's a loss, if your buy position is closed, what happened? You sold, right? If you're closing a buy position in profit, you're selling that position you bought. If you're closing a buy position in loss, you're selling that buy position in the loss. If you're in a sell position, if you're closing that sell position in profit, you're buying that sell position, right? You're doing the opposite when you close a position. So now exactly the same thing or the same concept, right, going on at this point, right, at this point. Okay, whereby people are buying up the market around this level, right? And then once price gets your stop loss, that's the equivalent of them selling because you're in a buying move. So once price closes them out, it is going to be the equivalent of that buy position. So that is equivalent to selling. So what simply happened here was IPDA drives price down. The central banks pairs up your buy orders with the retail sell orders. Does this make sense? Exactly. So stop loss converts buy position to sell position and closes at current market price once it. Correct. So once price hits the stop losses of anybody being a buyer around that level, remember you're now selling to get out of the positions. So who are you selling to? You're selling to the central banks. Because the central banks, for them to move the market up, they need someone to do the opposite of their trade, which is selling. So all they simply did here was they created a false window. They knew there was a fair value gap here that they wanted to reach for, but for them to reach that fair value gap, they had to trick people into buying. That was why, or that is why IPDA engineered price this way. So IPD engineered price this way to create liquidity below this price point where the central banks wanted to buy the market up. So as price got to that price point, right, the market exploded to the upside for about 50 pips, okay, or yeah, 56 pips basically, and took out any stop loss of any seller around this position. So does this make sense? What do you guys have questions? Let's see. Before we go into the next question, which is what is the next question? Higher time frame analysis breakdown. Okay. Uh, makes sense. Okay. So number three, I feel we've done that with top-down analysis. How many of you guys still need me to cover number three, higher time frame analysis breakdown? Or don't you feel we've actually done that with number two, top-down analysis? Don't you think? If you even just stop close to you, what is another Nick? What is another work? Skip it. Why didn't you push higher with the fact that institutional and the market? Okay, so let's get back to question. Right, so now the question is, why did price not push higher immediately after it took out this level? Bro, let me show you guys something. Now this is Wednesday, Tuesday, Monday. Okay, so now I want you to look at Monday's price action. Right, look at Monday's price action. Now on Monday, right, price created equal lows, where obviously retail stops will be resting at slash hedge funds, right? So there was a level of liquidity resting below this level. Look at when price took out this level, the price rally of that level immediately. The price just shoot up of that level. Immediately price traded through that level. No. Price waited until the next day and all of a sudden, boom. Just kept going higher, kept going higher, kept going higher, kept going higher for about 140 pip move. So not oftentimes you're gonna get a retracement intraday that would lead to a very explosive move immediately. Okay, oftentimes you're gonna see that setup will come the previous day, then going into the next day, right? You then see the explosive move. This is what we call. I think whilst I was studying Steve Murray, how many of you guys know Steve Murray? So I was studying Steve Murray. It was doing this MAAWVVM. I don't think anyone can relate to this. It's usually the liquidity exactly. Right. So basically, once you see total soups like this, once you see retail stops getting traded through, the next day you're barely going to find a Judah swing. So make sure you guys take very, very, very good note of this. Okay. Barely would you get a Judah swing like if you're looking for a bullish day, you want to see that false move down prior to London. Oftentimes, when you see the market do something like this, you would not really get that false move down prior to London, and the market will just keep going higher, 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 without even showing signs of want to stop. So I feel the same kind of action we got yesterday. That is what I feel we should get, unless we take out this level. As long as we remain above this level, we just see the price keep going up, no signs of slowing down, just keep going up. Okay. So for those of you guys on this call, make sure you're taking notes because oftentimes when I do Wednesdays calls like this, the market usually pans out exactly to script. So that way, if you're trading tomorrow, you want to utilize the information I'm giving right now to help you in your trading. Okay. All right. So if this happens again tomorrow, I'm taking this. What's his name? Steve Harvey. Oh God. Steve Murray, not Steve Harvey. This guy. Is that level where price is for our weekly gap on EU? So long, you're nice. So long. What a nice one. So long, your USD. Nice. Right. So let's go to the next question. Fair valuation. So let's talk about fair valuation. What is fair valuation? What is fair pricing? Fair pricing. Yeah. Right. So now, fair valuation or fair pricing is simply what I feel that is let's do it this way. Let's see if I can get a good example to cover this. And this is actually very, very tough. So we should look for fair valuation around a level. Okay, so let's do this. Okay, one more thing. Let me get the daily dividers first. Let me see what time this is. It's 11:20, and this is. So I feel like price. Where's my phone? Yeah, come on. So Euro USD. I need a new account. All right, so um let's go to 1 day. Okay, so now fair valuation or fair pricing. Now, what that fair valuation or fair pricing simply is when price gets to a level, right? Let me do an analogy real quick. So this is where the idea of a mean threshold comes into play, basically. So let's say you have a range, or let me drop that range rather than using this. Okay, so now let's say you have a range, right? This was a range in price, range in price, range in price, range in price, and all of a sudden, boom, explosive move. Okay, inside that range, that was where the central banks worked their positions for that bull move, for the bullish move. That was where the central banks worked positions for that bullish move. Right. So now, what price would then do is price would make a retracement back down to a discount level. Okay, so now what do I mean by discount level? Discount level, remember, draw up your Fibonacci tool. Anything below the 50% is your discount level. Okay? Exactly. Cheapness. SMTFX sniper. Yeah, so exactly. Once price gets below the midpoint, it becomes cheapness. Right. So remember what we taught on the higher time frame, right? The monthly. Right. Once price gets below that midpoint, it gets to cheapness level to a point where it looks like cheapness to the central banks, and then the central banks will then engineer price of that level. So this to them is a fair valuation. You're getting fair value for price. Okay. So you identify all ranges in all time frames. Not necessarily. Once you know where you're, all you need to know is where am I at in the grand scheme of things, right? Because remember, the market basically moves based off higher time frames. So eventually, the 4 hour, the 1 hour, the 15 minute is going to bow to the daily or the weekly or the monthly. So once you've identified your range on the monthly, oftentimes it is going to align with what you're seeing on the daily. Exactly. So once you identify your higher time frame range, you know that price, you know where price is going to on a long term basis, right? So you know where price wants to reach for. So what you then do is, okay. So what you then do is from that level where you saw that explosive. Now let's just for example Euro USD. What we saw in Euro USD today. So now let's say that Monday's range was the level at which the central banks bought the market. Okay, let me do this. Let me remove. Now, if I remove all drain zones, that is going to clear all I just. So let me erase all this first. Okay, erase all this. Okay. All right. So let's go to R2 set for. Finally. All right. So I want you guys to pay attention real quick to this. Okay, pay attention to this range. Let me remove all this. Pay attention to this range. USD. Okay, this range. This box. Okay, this box, and lastly, this box. Okay. So I want you to see how price reacted off all those boxes, right? So now, price made a range before price traded to the downside. Right, so there's a small little range, range low, range high, range low, range high. Then price broke to the downside, right? We traced back into that range, dropped down. Now, look how when price got to that range, okay, price didn't basically just reverse off this level and just kept going down. Price got back into that range, then dropped down. Now, this small little range before that move up or that move higher that we're looking for as a bullish move, right? There was a small little range up, down, up, down, up, down before price exploded out of that range. So the theory is inside of that range, central banks assume positions. Inside of this range, central banks assume positions. Okay, remember the central banks buy in ranges. They don't buy the expansion phase of the market. They buy the market whilst the market is making small little ranges. Okay, take note. The central banks buy when the market is in a range. They engineer a range to work in their positions. And price moving out of that range is a result of the net positions of the central banks inside that range. So the net position of the central bank inside this range was sell. Okay, the net position of the central bank inside this range was a buy. Right. So now the central bank sold inside this range. Right. Where were they reaching for? Basically, they were reaching for this old low. They sold inside this range, reaching for this old low because there's going to be some level of liquidity resting around that level that they can then take profit off of. That is this old low. Now, some sorry, some positions from this sell move inside of this range are still left. So what they'll then do is if they want to move higher, right? If they want to move higher, they will then assume bullish positions inside of this range as indicated by the expansion of the market from this small little range. As the market gets back, okay, remember, as the market gets back to this box, you're hedging the sell positions. As the market gets back to that box, you're hedging the sell positions. Remember, smart money edges the market. Okay, they don't buy and sell and get your stops. No, no. They hedge the market. They move in and out of positions. They move in and out of positions. This is why we track central banks open positions via the COT. COT just to track the central bank's open positions. So the central banks hedge the market. So it is very important for you to understand the central bank's edging phase right before you can understand the way the market moves. Higher, lower, up, down. Does this make sense? COT, comment of traders report. That's basically like it's kind of like an indicator or something that gives you the net position of the central banks in a currency. Okay. Yeah, so from range to range expansion, from range expansion back to range, from range to range expansion, basically. April 24, 2017, daily chart mark high low of the price gap. Look at how price trades EU. April 24th, 2017. Let's go to April. Let's see if we can get a very good example what Texas is talking about. So April 24th. So April 24th. Right, so let's see. Yeah, this is a very nice example. So if you look at price, let's do a replay basically to save all the stress. All the stress. Okay, so let's go to the 4-hour time frame. God damn. Don't tell me this Data is finished. Huh. Come on now. What the heck? Hmm. Let's go. The fuck knows? Tell you this. Let's see. What happened? What happened? Let's go. Let's go. Alright, so why is this just like that? Let's see. Panel. Right, so I don't know if you guys can hear me. You can see hear my voice. I think I had issues with my Wi-Fi, so try to fix it. Can you guys hear me? Type a one in the chat box, please, so we can continue this session. Show video panel. Okay, the screen okay. The screen's so blurry, or let me know. So basically, no complaints from you guys. So, right, so we can start. Yeah, so Bailey basically gave a very wonderful example of fair valuation in the marketplace. So now let's look at what the market did. Let's remove session breaks. All right, so the market basically created a small little range, right? Then what was the range where price did into before the expansion higher? This box. Okay, this was the range. This range was the range where price went to. The next range where price went into before that move higher was this range. Now look how when price goes higher, comes back into that range, explodes to the upside. When price comes back into this range, as you're gonna see right now, price comes back into this range, explodes to the upside. Okay, so price gets to that point, explodes to the upside. Should price get to this point, if price retraces back down, price will still explode to the upside because that is fair valuation to central banks. Basically, you can see the way the market expanded from that point. From the range, exploded to the upside about 700 pips. So that is a very wonderful return for that move. Okay, so that is fair valuation covered. Let's go to the next one. Weak candle formations. All right, so now weak candle formations, you want to use the daily. Okay, the only time frame I use candlestick formations is the daily. And so far in my 3 years of experience, I've used, initially when I started trading, I was using trend lines, right? So I know I did a lot of trend line traders right now. I was using trend lines. I was using MACD. I was using stochastic. I was using what else? I think Bollinger Bands. I was using all those trash, basically all of them, and it was mad confusing. When I initially joined IML, so I joined IML 2017. That was towards the end of 2017. I joined IML, and I think I was under Oran Wright on IML. I was learning from Oran Wright, right, and then was teaching all these candlestick formations. I was learning from Oran Wright at Daisy Duncan. Where else? Um, Brother Peeps. That was Gustavo. I was learning from Brother Peeps. I was learning from Abel Melendez. And all these guys were teaching was trend line. If price touches this trend line 3 times, damn, what a very, very big improvement from that time. So if price touches trend line 3 times, price is going to bounce. You see doji in the 4 hour. So basically the way I traded was something like this. When I was placing trades, right? So when I wanted to place trade, you see me do something like this. My full entire screen would be trend lines, like okay, one trend. I was always trying to find hidden trend lines on the chart. I was always looking for that hidden trend line that would be the key catalyst to move. And I was drawing this. I was putting up all indicators. So my chart basically was all messy because I wasn't really looking at price anymore. It was more of trend lines, indicators, different support resistance line. I was going all the way back to 2002 to find support lines. That was how crazy it was. So just day trade every single day. I was going all the way back to the initial price, like I think it was 1998 or something, 1980 or something. Looking for support from that line. Just wow, it was all crazy. So but what I noticed was that if you're looking for candlestick formations on the 4 hour time frame, oftentimes you're false retail patterns because majority of retail traders also look for exactly the same thing. So to me right now, candlestick formation on the smaller time frame doesn't really mean anything. So I'm not going to level saying, well, if you see doji around this point, buy the market because the market is going. I don't care about a doji. I don't care about anything. The only candlestick formation I care about is the daily, because a daily candlestick formation to me is the most important time frame you can find. If you look at a doji now, let's say for example, go to a monthly time frame. On let's look for live examples. Oftentimes, you know you're gonna learn that the doji is a reversal pattern. If the market is going up and you see a doji, the market is going to change trends. Oftentimes, if you check the monthly, that isn't usually the case. Okay. That usually isn't the case. Whereby the market creates a doji, you think the market is going to change trends. For example, look at this two down candles, right? So the market came down to this level, created two dojis, right? And all of a sudden, boom, down. Normally, what you're taught with retail strategy is once you see two dojis, the market is gonna go up. So on the monthly time frame, for my experience, candlestick formation does not work. On the weekly time frame, from my own experience, candlestick formation does not work. In the 4 hour time frame, from my experience, candlestick formation kind of works. It's kind of like a 60% thing. On the 1 hour, 15 minute, 5 minute, you ignore all that. Candlestick formation does not work from my experience, right? So the thing that actually works and the ones I utilize is the daily. Okay? The daily. Like for example, you see a pin bar to this level, you think, oh, next month the market is just going to keep going up. Because now there's a doji, there's a pin bar. Look what happened the next month. Down. The market just kept going down, down, down. Right? If you also look at the weekly is nothing really special because the weekly still does exactly the same thing as the monthly. Okay, now, for example, here we saw a doji. Yeah, so we saw a doji, the market traded lower. Now we saw a pin bar, the market still traded lower, right? Market went higher, it went down. Another pin bar, the market went up, came all the way back down. Okay, looking, yeah, so there's doji here, worked here on the weekly. There was this is called a spinning top. All right, so there's a spinning top here. The market went down. Okay, so showing signs. Here there was a doji. The market situated down. Another spinning top. The market still went down. Doji spinning top. The market still went down. What else? Pin bar. The market still went higher. Um, Pin bar, market should go down from this pin bar. The market still went higher. This is it? No, Angie man. This is not an Angie man. This is the what's it called? This is called a Angie man, and we've got can't remember this candlesticks. All these names. All right, so spinning top, the market still went higher. 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 All right, so doesn't really work. Let's go to daily. Let's see what the daily does. Now daily, yeah. Now doji, the market goes up. All right, so doji, market goes up. Pin bar, checking out this point, the market trades down. Here, respectively, the market trades down. Spinning top, the market goes up. Doji, the market goes up. Spinning top, the market goes down. So you can see just by looking up, well, previous price action that the market respects candlestick formations on daily. So what the daily simply is a reflection, right? So take down this note because I don't think I might talk about this anymore because I don't really do candlestick formation. So, but this is just one tool I add to my arsenal to trade. Right. So basically, what you're seeing on the daily is a reflection of central bank's action for that day. Okay. The daily time frame, what you're seeing on the daily is a reflection of the central bank's action for that day. Now remember the central banks and the banking, sorry, the central banks and the hedge funds, right? So hedge funds and banking, okay? They execute on the daily time frame. So oftentimes the key to unlocking daily time frame basically is if you see something like this, right? So now let's say this is a bearish candle and you see this. What basically this is telling you is the market opened and then went higher than the opening price, but something drove price all the way back down for some reason. Something drove price all the way back down for some reason, and that thing that drove price down all the way back down did not want price to get there, did not want price to remain there. So basically, you can expect the next day you can see a rollover in price. Because the thing that drove price down all the way back down would want to see a continuation from the positions as during the previous day. Right, so the wicks now, the direction of the wicks now is a very good telling factor. Yes, of course, you need to couple that with your premium level and also your discount level. But now the positioning of the wicks is a very telling factor where the central banks are trying to drive price to. So now let's say you see two candles like this. Okay, let's say just candle one, candle two. Right, you see something like this, candle one. Let's move this to the left. We clone this one. Then we see something like this on the right. So, which one is the bullish move and which one is the bearish move? Let's call this A. Let's call this B. Okay, so we call this A. Call this B. Okay, so B. Right. So, if you're looking for a bullish move on a daily time frame, what do you think is the more likely prospect in terms of candlestick that will cause a very bullish move the next day? Is it A or is it B? A or B? Let's see. A. Bullish. Exactly. Yeah. A is going to be the candle on the daily you want to look for as bullishness. Reason being, something drove the market all the way back down, but for some reason the market never wanted to stay at that level and reversed all the way up to close higher than the market opened. Okay, because the market opened very, very bearish, but for some reason the market was driven all the way back up. Okay, and traded remained higher than the market opened. That to me is an indication of an entity that wants to push the market higher. That is why when you go to your daily time frame, you're going to see that recurring on your charts. Okay, so let's look for a very neat example. Let's see. All right, so the market was bullish for a period. So down candle this, bearish shadow block also this. So down candles. So move this. So this last two down candles, bullish shadow block in price, right? So bullish shadow block in price. Now look at when the market came all the way to this level. Let me point your attention to the last candle before that move up. Okay, so look at this week. Look how the wick to the downside is longer than the wick to the upside. Okay, the wick to the downside is longer than the wick to the upside. That is showing rejection of that level. So this is how you can couple candlestick analysis with your PDR range, your fair value gaps, your bullish order blocks, your general market sentiment. You can couple that with a candlestick analysis, especially on the daily and sometimes the 4-hour time frame. Okay. So if it's in the middle, it's an indecision that could also signify potential reversal in the cards. Okay, you also have to um, align that with your general market sentiment, your institutional order flow, all those varying factors. So the market is not something whereby you just use one thing to trade the market. You always want to get that confluence of factors before you place a trade. And the daily candlestick analysis is just one way of you to confirm if your analysis is correct or if your analysis is wrong. So we're done with 2, 3, 4, 5. Right, so the magnet source right now. This was actually Racing that told me to cover this. So the magnet source simply is IPDA. So IPDA is always going to drive price to the level of fair value or to the level of liquidity. Those are the only two objectives of IPDA. So let me give you an example. So this is why I call this the magnet source. Now there's a let's do it this way. Right, so let's play the marker up. That's what the market is going to do. Now, look at what the market did around this level. What do you think people are going to do around this level? Both hedge funds and both the retail traders, right? What do you think they're all doing around this level? After they saw this very, very clear information, after they saw that very clear information, what do you think they're doing around that level? Are they buying or they're selling? Question. Are they buying or they're selling? You're buying around that level. Are you talking about, is it the double tops? Are they buying or they're selling? Baby Jane. What the fuck is Baby Jane? This is funny. Yo, can you text me on Instagram? Let Baby Jane text on Instagram. That is funny. All right, so do you think people are buying or just selling around this level? Baby Jane is actually a nice name. Baby Jane. So I think about 4 people said selling and 2 people said buying. Okay, one buying, selling, 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 selling. Okay. Right, so now majority of people are going to sell. Why? Because what they teach you in the retail sphere is if you see a double bottom, you buy. You see a double top, you buy. If you guys think I'm lying, look at the IML presentation slide. Okay, this is not just an IML, but I'm just saying look at the IML presentation slide. What they show you there in the presentation slide is when you see the double top, you buy. When you see the double bottom, you buy. Okay. Oftentimes this strategy works. For example, in this case whereby there's a double top and look at the way the market dropped down. So this strategy is not as if IML is being wrong or something. This strategy works, but the downside to this is that this doesn't really occur as long-term moves because oftentimes you're going to see the market trade back up through those levels. Why? because the market has engineered liquidity around that level. So the magnet source right now is the liquidity in the marketplace, because once there's a liquidity created in the marketplace, that will be a magnet for price. That is going to be a magnet for price. Okay, so now you know that price is reaching for a discount array. Remember what I taught you in like the last couple minutes, right? You find your range low to your range high. Pull up your Fibonacci from that range low to range high. Okay, so the anything below the 50%, that is what you want to use for your buying. Okay, the 50% to below, that is your fair valuation, because that is where the central banks are going to want to come and buy the market up. Okay, so now look how we're coupling all these different ideas together to get a singular move. Now, sorry. So now retail sees this, the market trades significantly off this level. There's going to be people inside of this sell move with stop losses above this high. Okay, now what entity would trade this long-term move? Is it retail or is it the hedge funds? I'm actually got that question. Is it retail or the hedge funds with stop losses above this level? What do you think is going to have liquidity around that level? Retail or hedge funds? Hedge funds, not retail. Hedge funds. So now I'll tell you the reason why. Because retail, when retail trades move, how many of you guys can actually hold move for 2 weeks? Let me ask you guys that question. How many of you guys can hold move a certain move for 2 weeks? From 1 week going into 2 weeks. How many of you guys can do that? You're going to stay in a move for 2 good weeks. Say yes if you can, say no if you can't. Exactly. Baby Jean says yes. No, yes, not there yet. Okay, no. Baby Jean. Yes. Alright, so I want to get more input into all this. I can't even stay 20 minutes. Yeah, so the general consensus, right, is that majority of retail traders we don't want to hold a trade for 1 week going into 2 weeks, right? Reason being that they are basically people are impatient to see a move play out. So people are very, very impatient. They want to see the money quickly. They want to see the results of their trading. Even myself, I generally don't hold move for more than a week. So once it's starting to get more than a week, I get discouraged and I close that move. So oftentimes, the maximum I can hold a move is 2 weeks. So for those of you guys seeing me swing trade, oftentimes that 1 week move is a very explosive move in the market. So oftentimes I can't just hold a move for 2 weeks, right? But the hedge funds now can do this because the hedge funds are trend following. Keyword trend following. What is the trend on your USD? Downtrend. So hedge funds are looking for any opportunity to keep selling, Why? The hedge funds are trend following. Okay? So now, the hedge funds will position themselves inside of this move. Once they see a breakout, okay, let me explain this to you guys. Once the hedge funds see a breakout of this level, this prior swing low, they look at this as a break in market structure, and then you're inside of this move looking for sells below this last low because you're following the trend. Now, this is what the central banks want to see price do. They're engineering price so that they can then stop the hedge funds out. So now let me tell you guys something. The best swing opportunity is when there's an hedge fund liquidity above an old high or below an old low. Because hedge funds provide way a lot more liquidity than retail liquidity. So retail liquidity is only being run out in the sense of the 4-hour time frame, the 1-hour time frame, the 15-minute time frame. Any liquidity you're seeing on your daily, take note, write this down on your notepad. Any liquidity you're seeing on your daily is on the hedge fund level, on the hedge fund basis, because the hedge funds place stop losses via the daily time frame. and you're going to see price trade aggressively towards that level. Why? Because there's hedge fund liquidity around that level. So that will be a magnet for price. That is going to cause a magnet for price. And that magnet in the sense of IPDA. So IPDA is going to drive price back to that level. But the central banks will consider that level as a very, very profitable level to take the opposite side of the trade, basically. So what you then see is price will drive down into a fair valuation, right? The price is going to drive down into a fair valuation. And once price taps that level, you know now that price is going to be drawn by the IPDA, not the central banks. IPDA is going to draw price to that level because IPDA's job is to seek fair valuation or to seek liquidity in the marketplace. Those are the only two functions of IPDA. So IPDA is going to drive price back to that level. So this creates a kind of a swing term objective for you to look forward to because you know now price is going to reach for this level, right? And as you can see in the resulting move, price trade higher, comes back down, total suits this last low, okay? Price takes out this last low. So anybody buying inside of this move has been stopped out like this. So now you're going to see a very, very explosive move. You want to see the next day be very explosive because the buyers just got stopped out. And then your target is that level. Exactly. Can you see how very explosive this move was? Very, very explosive. Because price just made a stop run. Okay, so now keep going. You want to see the market trade higher, all the way up into that level. And look how the market spiked that level. Grab all liquidity around that level because this has created a magnet for IPDA via the liquidity. So does this all make sense to you guys? IPDA stands for Interbank Price Delivery Algorithm. Okay, IPDA. This basically is the AI of the central banks. Okay, let me type this out. Interbank Price Delivery Algorithm. So this is the AI of the central bank. This is what the central banks use to engineer move efficiently and effectively. This is what IPDA stands for. Interbank Price Delivery Algorithm. Okay, so let's see. IPDA will always drive prices to fair, FOG or OB, fair value gap. No, I said IPDA will drive price to a fair valuation. Fair valuation meaning a discount or premium level as it relates to the marketplace or a level where there is massive liquidity resting. Okay, massive fund level liquidity resting. Remember the battle in the market is between the central banks and the hedge funds. Okay, the central banks and the hedge funds are constantly battling and the central banks wins every single time. They win every single time. So let's go to the next one. We're at magnet source has been covered. Bread and butter setups. I think we have 4 more, so I'm going to try to rush through this. I will incorporate CBDR with bread and butter setups and Asian range. Then okay, so let's do it that way. CBDR, bread and butter setups, Asian range. Oh, candles actually show 15-minute time frame. All right, cool. So what I'll do is session breaks. Okay. All right. So going back to what I taught you guys about, right? So we know, right, that price took out a prior swing low around this level, and there's a liquidity here that IPDA will draw price into. So now that gives us a perspective what we want to do every single week. Okay, let me show you guys once more. So you go to your daily. Let's go to the daily time frame. So we go to the daily time frame. Come on. All right, so we know that this is a fair valuation for price to reach for. And this is also a level where liquidity rests in the marketplace. So we know now that IPDA will drive price from this level into this level. Okay, so now if we were positioned around this level and we got stopped out here when the market came back down, you what you want to do is you want to re-enter the marketplace because you know now that any buyer inside of this market has been stopped out. And you're often going to hear me say something like the best move comes after you get stopped out. Okay, after a level of stuff has been run out in the marketplace, that is where you're going to see the best moves. For example, this explosive move, this very explosive move, came on the heels of market running through this price swing low. Okay, so now once the market does something like this, and you know the market is reaching for what the fuck? Are you telling me? And you know the market is reaching for a level of liquidity around this point. That then narrows your focus to only one thing. So let me ask you guys this question: what do you want to be doing until the market gets to the zone? Do you want to be buying or you want to be selling? What do you want to focus on each week until the market gets to that zone? Buys or sells? I'm going to show you how very easy it is for you to trade. Very, very simple. Very simplistic. Do you want to buy or you want to sell? What do you think would be more profitable for you to buy or for you to sell? Sell or buy? Sell. Where says sell? Why would you want to sell the market if you know the market is going bullish? So, Wes, let me ask you a question. Is the market going bullish or bearish? You want to see the market go bullish or bearish? Exactly. So if you want to see the market go bullish, do you want to buy or sell? Exactly. Because the market is going higher. So you want to see the market buy or you want to buy in line with institutional order flow. So that narrows down your focus to what you need to be doing every single week. Now, what days did I tell you are the best days for you to trade during the week? What days are the best days for you to trade during the week? Tuesdays to Thursdays, exactly. Tuesdays to Thursdays, exactly. When is the low of the week most likely to form on bullish weeks? When is the low of the week most likely to form on bullish weeks? Tuesday to Wednesday. Okay? Sometimes Monday, but Tuesdays to Wednesday, 80% of the time. If it does not form on Tuesday to Wednesday, then on Monday it is going to form. Correct. So now, if we know that the market just took out a level, just stopped run a level, and the market is reaching for this level, now we have a swing target objective. We know that the only thing we want to be doing is buys. We want to focus on buys, only buys, no sells. Okay, so what that means is you're going to your 15-minute time frame, right? Let's make this smaller. All right, so now let's find the week dividers. Excuse me. Oh shit, my chest. Right, so now let's find the weekly dividers and look for when each new week starts. Let's see, 22. So this is the start of a new week. Okay, 1, 2, 3, 4, 5. Start of a new week. Okay. 1, 2, 3, 4, 5. New week. 1, 2, 3, 4. 1, 2, 3, 4, 5. New week. Okay, so new week, new week, new week. Right, so let's go back to the original point where price ran through a level of stops, right? So now this is 1 week, right? On Monday, price was very slow. Tuesday, going down, going all the way into Friday. So on Friday, price made a stop run. Okay, so on Friday, price made a stop run. Now on Monday, do you expect the low of the week to come on Monday? Or do you expect the low of the week to come on Tuesday going to Wednesday? Let me ask you guys that question. You expect the low of the week to come on Monday, or do you expect the low of the week to come on Tuesday slash Wednesday? This is where you gotta think critically. Now I said 80% of the time you can expect the low of the week to come on Tuesday slash Wednesday. But now remember, we just ran through a level of stops on Friday. Okay, we just made a stop run on Friday. Remember, so if we're making a stop run, what do you want to see price do next? Explosive move, because we just ran through the level of stops. Explosive move. Okay, remember the session I taught you guys on the breaker and failure swings, right? Breaker and then failure swings. So Monday, because the stops are cleared exactly. So the price just made a stop run on Friday. So on Monday, you want to see the low of the week form. Okay? You want to see the low of the week form on Monday. So now, if we made a run for stops around this level, the question you got to ask yourself is where the central banks sell into to pair up their buy orders with sell orders below the daily swing points. Okay, because you know definitely just liquidity resting below these two zones. Okay, and then the market basically traded into that zone and exploded to the upside. Now, for the market to trade into that zone, central banks had to sell price into that zone. Remember, the central banks never lose a trade. They move in and out of position. So if the central bank sold into this zone, right, that sell point where they sold price into, they would want to move price back to that point so they can then hedge their positions. So we extend this out as this was the last point where the central bank sold price. That, and basically on Monday you have a power of three setup. So now I'm going to incorporate this into Asian range and what's it called? CBDR. So let's look at this move. Let's see. So this was a very tight move, right? Very, very tight move. Central bank dealers range starts from 8 p.m. GMT to 2 a.m. GMT. Okay, so 8 p.m. to 2 a.m. is the central bank dealers range. We're going to use the candlesticks bodies for this. Okay, central bank dealers range. Now, central bank dealers range basically is that the idea behind that is that between 8 p.m. GMT to 2 a.m. GMT, right, there's going to be a small little consolidation created by price where the liquidity for that day is at its lowest. Okay, the lowest times for liquidity is the central bank last range. Now, if the market is going to go bullish, oftentimes you see how do I put it now? So you see the equivalent of the distance between the top of the central bank dealers range to the bottom of the central bank dealers range. You can then create a exact replica of that box and stack them upon each other to create a standard deviation from that range. Okay, so now remember we're looking for buy days, but we're looking for Judah swing lower before we see the explosive move to the upside. So if we're going to trade one size of this central bank dealers range box, that would constitute one standard deviation. So this is one standard deviation right here. And that was where the market traded into one standard deviation before the market exploded to the upside. Okay, so let me see. Questions so far. I'm really, really surprised that people are not asking me questions concerning this. Is that every single night you get a central bank dealer range? Every single night. Now, the The key to this, okay, is that the range has to be tight. It should not be very big, explosive. Relatively, want to see a 20 to 30 pip range for the central bank dollars range to work. You want to see a 20 to 30 pip range. Okay? 20 to 30 pip range. And then for those of you guys who need more questions on central bank dollars range, that is taught on the daily section, the day trade section of the full course, full SMT course coming out this weekend. So I think team covered that on the day trading section of the SMT course. So you guys can just go through that when the course comes out and then get an insight into how central bank dollars range work, because that is a very, very broad topic for me to cover. I can't do that in one session. Okay. So I think we have about 20 more minutes before I end this call. So let's try to make the best of this. Okay, so the market gets all the way down to this level, trades higher. So you know you're looking for bullish moves every single day. So where is our 8 o'clock? Let's look for the central bank dollars range 8. So this is 8. Okay. 8 starts from that level until 2. Alright, so market trades down. Alright, so remember what I just showed you guys on Euro USD today, whereby the market creates a level of stops, runs through that stops, and trades higher. So we have a level of stops here via the double bottom. The market simply goes to that level of stop and goes to the top of the range. That's Tuesday. Wednesday, you're also looking for a bullish move on Wednesday. Okay, the same scenario we saw on Euro USD today is exactly the same thing that played out on 4th of December. Only difference is the range was way, way, way higher than what we saw today. So basically, so what the market basically did was create a level of stops. Right, everyone thinks, well, everyone knows the trend is bullish now. But now everyone sees this, they want to buy up the market around that level. So price creates that stop because the institutions want to move price higher. They pair up the sell side liquidity with your buy side orders, and the market comes down to the level, clears the stop, and the market runs through. So basically, if we take our central bank dollars range from 8 o'clock to 2, okay, so 8 o'clock to 2 a.m. This 2, okay, 2. So 8 o'clock to 2 a.m. and we get one standard deviation of that range, okay? One standard deviation. Look how accurate this is in giving us entry, precise entries, right? So one standard deviation of that range, that is where the low of the day basically comes in, and then of that we can see very explosive move again, about 44 pips of that move. Okay, 44 pips of that move. So you can see on Monday we traded a bullish move. Tuesday we traded that bullish move. Wednesday we traded the bullish move also. Thursday you can stay out because the market will begin to want to retrace to complete the weekly range profile, which is the market trades down, open, low, high, close. So the high usually comes around Fridays. You can see just like you saw here. Okay, exactly. This is very perfect. The market makes a corrective market structure on Friday to complete a weekly range, basically. So I think I covered that with central bank dollars range, and let's see. I want you to know when you cut the ILO of the weekend, complaining of hold it on Friday. So the key is you don't want to hold the move until Friday. What you're looking for is an opposing PDRA for price to trade into. Because if you're in a buying move, remember you're buying from a discount. Just like the central bank, you want to buy low and sell high. So the key to this is when you're buying low, you're looking for an opposing premium array to sell to. Or to sell at, not to sell to, okay, to sell at. Okay? So you're going to hold your buy positions until you get to your opposing premium array. And oftentimes that premium array is going to come on the heels of a daily time frame. So you want to use a daily time frame from that for that, basically. Okay. So now let's say the first week where we took this buy move, right? So we bought the market around this level, and where we can expect our weekly high to at least come into play would be this order. Okay, old daily high. When I see price trading to that, so that could be a swing target for the week. We want to see the price. We want to see the market trade into as a potential high of the week, and the market to trace away from that level. So we could use this level, or we could have said basically this British order block. I want to see price trading to that British order block, which price ultimately does not get to, but price gets to that level the next week. But remember, price does not really get to the level where we bought. Because at that level where we bought, that was where the central banks also positioned themselves to, buy up the marketplace. So anytime we get a move in line with institutional order flow, that is going to align ourselves with what the central banks are doing. That way we can't get stopped out because now we're taking positions where the central banks took positions. So we can't get stopped out until price reaches an opposing premium array. Does that make sense? This web is getting very long. Does this only work for the end of the week to the beginning of the week? I don't get. Kevin, I don't get your question. Does it only work for the end of the week to the beginning of the week? I don't really get your question. So let's go to the last two questions. Mindset for swing trading and IPDA. So why does IPDA exist? Okay, let me talk about this real quick. So IPDA exists. We've got about 4 more minutes. I'm going to try to do this. Yeah, exactly. Daily time frame is very important. Wes, you're confused about what? What is confusing you? If you're confused about anything, what I suggest you do is this is why I said I wanted to create the SMT course. Myself and Tim wanted to create the SMT course because some of you guys come on the webinars and you're learning CBDR today from Gene. The next day you're learning other blogs from Nick. After the next 2 days you're learning Fair Valley Gal from Tim. So you're just getting thrown all over the place without no real direction, no real sense of what do I need to do because you're just learning different things every single time. And for like the last 3 to 4 months, this is what people have been complaining about. So what I decided to do along with team was to let me show you guys every every aspect of trading. Right, yeah, exactly. So Team Bailey is the scalper, then Nick and Texas Trader and Ecapsis, you're mainly day traders slash short term traders. And then myself, I'm kind of like more of a swing trader, right? So what I did was I gave team the scalping session, learning from London Snipers. I feel London Snipers doesn't really scalp more. They often day trade. So what I did was I gave team a section on scalping, since team is very good at scalping. And I gave Texas Trader and London Snipers a session on short-term trading, since you're very good at short-term trading. And then I myself took higher time frame trading, since that is what I'm very good at. So everything is all covered. So the best in each area is teaching you the knowledge. So the best in higher time frame, which is myself, best in short-term trading, which is Texas and London Snipers, best in scalping, which is Tim. So everybody's covering your own zones and teaching you what you really need to know. So that way, once you get access to the full course, you're getting taught everything in order with structure from the beginning to the end. So that way you don't get confused. And the other thing we need to do every single webinar is just reinforce the idea that you learned on the course. Okay? So that way it makes it very, very easy for all you guys. Because now more than ever, you guys need to know how to trade. You guys need to stop relying on team for signals. You guys need to stop relying on London Snipers for signals. And you guys need to stop relying on Gene for signals. And you guys should start to learn how to take signals yourself. Okay? Because I feel what the market is going to present the coming weeks is going to be very, very insane. And for you to really, really survive in this niche, you need to be independent. You need to be self-dependent. Which is why I decided we need to create this course and get this course out on time. So every single person can, anybody who basically dedicates your time to learning the concept on that course, everyone is going to be successful. Exactly. Most people who come to me have basic knowledge of institutional concept, but they can't put anything together because there's no structure to the way they learn. So what I decided to do was I structured everything from beginning to the end. That way, once you go through the course, I promise you, everything would be very, very clear for you. Okay, so all you need to do is just go through the course, and that is it. So, I don't really think I need to cover swing trading. I covered that on the course. IPD, I covered that on the course. So I think with that being said, that brings me to the end of this webinar. Because the mindset for swing trading, that is one full section. Okay, on the course. So I feel you get that more if you're just a little bit more patient. And then IPD, I talk about IPD on two different sections on the course. So if you're just being patient, you get everything you need to know about IPD. So just know I got you guys covered with the course. Myself, Texas, London Snipers, team, we got you guys all covered with the course. We're going to make sure we bring it out this weekend. And we're going to find a way to protect that course. And after that, I promise you, it is going to help you immensely with trading. Okay? Because our goal is to get you guys to be self-reliant and not really, really have to rely on us. Okay? So by doing that course, that helps us help you, basically. All right. So this is your question so far. Thank you guys for putting up with my shitty Wi-Fi. Also, thank you guys for being a part of this call. Oh, how many of you guys enjoyed this call? Let me see. How many of you guys found value in this call? How many of you guys? Yeah. How many of you guys really really found value in this call? Drop a number one on the chat box if you found value in this call. Let's go. Let's go. One one one. Let's go. We want people on this call. Let's go. Right, so thank you guys for being a part of this call. I'll see you guys Saturday when we do a launch. After we do a launch of the course, planning on doing a challenge just for fun, basically. I might, I will, not I might, so I will. My goal is to take 1,000 to 7,000. Looking at a 2 week period, not really, really trying to over leverage, just trying to do something really, showing the concept and explaining what I used to get into trades, how I did that, probably with daily market breakdown of what I looked at when taking that pair. So with that being said, hopefully you guys look forward to the call corner during the weekend. I'll see you guys next time. Thank you all for being a part of this call, and good day. Not cringing. Additive, additive, promises, 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 promises. Infected by pessimism. That's fun. A something nice.
M'appelle Sam Nelson pour les nouveaux arrivants. J'espère que vous allez kiffer nos nouveaux contenus.
Just fucking.
Je vous conseille d'aller le voir. Voilà, voilà. Bon, il est sur Netflix et je vous mets quelques extraits là. Torunun küçük bir kızı olmuş gölde.
It's fucking like you are scared as fuck. I can't back. Oh shit. Shit. Shit.